Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about United States Antimony Corporation Annual Report. United States Antimony Corporation offers a diverse range of products and services across various industries. The company's antimony segment provides antimony trioxide for flame retardant systems, color fasteners, and phosphorescent agents. It also supplies antimony metal for use in bearings, storage batteries, and ordnance, as well as antimony trisulfide as a primer in ammunition. The zeolite segment offers coarse and fine zeolite for various applications such as soil amendment, fertilizer, water filtration, mine ventilation, sewage treatment, environmental cleanup, odor control, gas separation, animal nutrition, and more. These applications include catalysts, petroleum refining, concrete production, solar energy, heat exchange, desiccants, pellet binding, litter, floor cleaner, traction control, and carriers for insecticides, pesticides, and herbicides. In addition to its product offerings, the company also recovers unrefined and refined gold and silver. With a presence in both the United States and Canada, United States Antimony Corporation has been serving various industries since its founding in 1968. United States Antimony Corporation maintains a market capitalization of $1 billion, broadly in line with the industry peer group. United States Antimony Corporation trades at a higher price-to-book ratio of 8.1 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The balance sheet appears very conservative, with liabilities representing only 17% of total assets. While this indicates low financial risk, investors should examine the composition and quality of the company assets to determine whether they justify the current valuation. Liabilities have increased, while assets and equity have failed to keep pace or declined. This suggests the business is not growing and may be in decline, making it a highly unattractive investment from a risk perspective. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth for a company can be attributed to several key factors. Securing large contracts such as the $248 million IDIQ contract with DLA Strategic Materials and executing 5-year sales agreements with new industrial customers have significantly contributed to revenue growth. Expansion into new industries such as animal nutrition through strategic partnerships has also been a major driver of revenue growth. In addition, acquisitions and investments in various assets, including mining claims and leases, properties, and existing housing developments, have provided opportunities for revenue growth. Furthermore, increased sales pricing and higher levels of inventory on hand have also contributed to revenue growth. On the other hand, revenue decline can be attributed to factors such as limited surface mining and exploration activities, which resulted in no revenue recognized under IDIQ contracts in fiscal 2025. Investments in field operating activities, including ore separation and storage, have also led to a decline in revenue. Overall, the company's revenue growth is driven by strategic partnerships, large contracts, and investments in various assets, while revenue decline is primarily due to limited mining and exploration activities. The net income of the company experienced a significant decline between 2024 and 2025. In 2024, the company reported a net loss of $1.7 million, which increased to a net loss of $4.3 million in 2025, representing a 153% increase. This substantial decrease can be attributed to several factors, including non-profitable processing of ore from new suppliers and internal sources, credit and liquidity risks associated with the loan to an international supplier, and potential shortages of feedstock for smelting operations. In contrast, the company's profit margins showed a significant improvement in 2025. The revenue growth was substantial, increasing by 164% from $14.9 million in 2024 to $39.3 million in 2025. Additionally, the gross profit also saw a notable increase of 185%, rising from $3.5 million in 2024 to $9.9 million in 2025. However, despite this improvement in revenue and gross profit, the net income remained negative due to the aforementioned reasons. The potential risks associated with the joint venture, such as operational difficulties or failures, reduced throughput at the refining facility, and dilution of ownership position, may also impact the company's profit margins negatively. These factors highlight the challenges faced by the company in achieving profitability despite its revenue growth. The company's financial situation has undergone significant changes in terms of debt and interest expenses. A notable development is the increase in long-term debt, which rose from $195,425 in 2024 to $327,677 in 2025, only to decrease sharply to $58,483 by the end of that year. This fluctuation suggests a volatile financial landscape. Furthermore, the company's interest expenses have also seen a substantial change. The cash paid for interest increased significantly from $8,869 in 2024 to $16,654 in 2025. This increase indicates a higher burden on the company's finances due to its debt obligations. The company's segments and regions have shown varying levels of performance. The antimony segment has been a standout performer, with total assets increasing significantly from $27,230,312 to $137,013,360. This growth is a testament to the segment's potential for long-term success. In terms of regional performance, Montana region has also performed well, processing ore containing antimony and precious metals. This achievement highlights the region's ability to extract valuable resources efficiently. On the other hand, some regions have struggled to meet expectations. The Mexico region remains inactive, with no revenue-producing operations yet established. Similarly, the Alaska region has acquired mining claims but lacks operational data, indicating a need for further development. Overall, while some segments and regions have excelled, others require attention and investment to reach their full potential. Management is optimistic about the company's outlook, citing sustained market demand and reduced supply as drivers of revenue growth. The company plans to continue purchasing ore from a single supplier in Canada throughout 2026, which will help maintain supply reliability. To further drive growth, management intends to invest in employees, customers, infrastructure, and operations, with goals of increasing production, decreasing costs, and growing revenue profitably. The company's mission is to serve employees, customers, and vendors with excellence while growing the business through organic growth and strategic acquisitions and partnerships. This mission will be achieved by expanding product offerings through new mining claims and properties acquired in 2026. Management expects sustained market demand for antimony to continue increasing margins per pound sold, which will contribute to revenue growth. Overall, management's strategy is focused on investing in the company's core operations while exploring opportunities for expansion and growth through strategic acquisitions and partnerships. By maintaining supply reliability, expanding product offerings, and investing in employees and infrastructure, the company aims to increase production, decrease costs, and grow revenue profitably. The company has made several significant acquisitions and divestitures in recent years. In terms of acquisitions, the company has expanded its mining operations through various agreements and purchases. Notably, it entered into a joint venture agreement with America's Gold and Silver Corporation, acquiring a 49% ownership stake. The company also acquired surface rights to one of its mining claims in Montana and purchased additional properties in Alaska and Ontario, Canada. Furthermore, the company has made strategic investments in exploration rights for mining properties in the southeastern United States and acquired shares of an Australian-based public company through open market cash purchases. Additionally, it acquired treasury stock in 2025, totaling $574,153. On the other hand, the company has also engaged in divestitures, including selling its interest in certain operations in the event of a deadlock with its partners. The company has also mentioned that it may sell its operations to third parties, which could potentially lead to liability under CERCLA. The company's financial activities have been focused on share buybacks rather than dividend payments. According to the provided information, the company has acquired treasury shares through various means, including purchasing 149,639 shares in 2025 for $574,153. Additionally, a total of 951,667 shares were bought back through stock option exercises. These transactions indicate that the company is prioritizing share buybacks over dividend payments to its shareholders. The company's use of treasury shares to pay for exercised options and mandatory payroll tax obligations further supports this conclusion. This suggests that the company is managing its cash flow by retaining shares rather than distributing them as dividends. Overall, while there is no clear indication of dividend payments, the company's share buyback activities are evident throughout the provided information. Concerns about inventory buildup and supply chain disruption. The extracted summaries reveal several red flags regarding inventory buildup and supply chain disruption. On page 18, there is a risk of ore supply disruptions due to shipping delays at intermediary ports, uncertainty about product content, quantity, or grade from non-domestic suppliers, and the potential default by an international supplier on a $2.5 million loan. Furthermore, pages 52 and 54 highlight significant increases in antimony inventory, $12,016,138 versus $744,550, and total inventories, $12,522,009 versus $1,245,724, indicating a substantial buildup of inventory. This is corroborated by page 54, which explicitly states that there is an inventory buildup concern. Additionally, page 66 notes that a significant change in market price of antimony could have a significant effect on the net realizable value (NRV) of inventories. These findings collectively suggest that there are legitimate concerns about inventory buildup and supply chain disruption, which may impact business operations and financial stability. That concludes the financial summary for United States Antimony Corporation. Feel free to comment below, and I will be happy to answer them when possible.